Welcome to Rural Report, a program that enlists experts to provide Kansas farmers and ranchers with the latest information about how COVID-19 is affecting agriculture. Rural Report is a special production of Kansas Farm Bureau in partnership with KFRM's Duane Toews and WIBW's Greg Akagi. Talking on this second edition of Rural Report, have the opportunity today. Rich Phelps, the president of Kansas Farm Bureau, joins us along with Leonard Wolfe with United Bank and Trust in Marysville, Kansas, talking about ag lending. And certainly we think about a very busy time of the year when producers are headed to the field trying to get those fall crops planted. Obviously, spring calving is kind of wrapping up and guys looking forward to going to grass. It's an interesting time in the midst of a global pandemic. Rich, let's lead off as a farmer and president of Kansas Farm Bureau. Can you give us a little insight into what agriculture producers are facing from a cash flow standpoint that you've heard discussions of?
Thank you, Duane. I appreciate the opportunity to be with you on this today. And, you know, we're at trying times. Before we ever heard of COVID-19, we were facing some challenges in agriculture as a result of a lot of different things, but the COVID-19 has obviously made it much, much worse. And I think as we talk about lending and access to money, it's important that we have a partner in the banking industry that can work with us. And particularly at this time of year, springtime is a high cash period of time when a lot of money is needed to put a crop in. If you're in a cow-calf operation, you sold the cattle last fall, you're starting out a new crop, got rents and those type of things to pay. So from that standpoint, it's really challenging. But the other thing is the commodity prices, and they're so depressed. And, we can look long-term at the stock market, but that's long-term. But when we look at commodities, people have to have the sale of those commodities to meet their cash flow needs. So a very concerning time.
Leonard, from your perspective, have you seen more or less activity in the Office for Ag Loans since this crisis has started?
Yeah, Duane. First of all, United Bank and Trust is about a $700 million community bank. We're based here in Marysville, but we have 14 branches that are located in 6 northeast Kansas counties, just so you know where we're located. This is always a really busy time of year for us because we like to have our annual operating lines of credit renewed kind of after the prior year end results are finalized. But then with the Fed's lowering of the interest rates, we've also been fielding a lot of questions about rate reductions, et cetera. And then on top of that, we've been tasked with the Paycheck Protection Program, the implementation of that. So many of our lenders have been working pretty much overtime for the past few weeks. But we're seeing it busier than normal, but this is always a busy time for us.
Thinking about that time of year, it is extremely important. Rich, kind of going back a little bit to what you talked about with the cash flow, it's interesting the setup that we're in. Agriculture has seen a series of cycles from highs to lows. Do you think that makes agriculture as an industry maybe more prepared to deal with this than the general public?
Well, I think there's some real possibilities to that. You know, we're an industry that's used to not living paycheck to paycheck. We're used to saving a heifer, raising a calf crop, and then selling a calf at some time down the road, planting a crop in the spring, having a crop to harvest in the fall. So I think we may be somewhat more prepared. However, it takes money, though, to be prepared. And that's the main issue that we're facing right now is the lack of money in the overall system to do what we need to do to function.
Next question I'll pose to both of you. Leonard, why don't you lead off? How important is it in terms of that relationship between a ag producer and their banker? And what can people do to improve those relationships, not only now, but as we look forward to the years ahead?
Yes, that's a loaded question, but obviously relationships with our customers is extremely important. But it's really in uncertain times like this when that relationship is mutually beneficial. Our customers know we're going to be there for them and here for them in these times like this. So, that trust doesn't happen overnight. It just takes years and years to develop. and it usually takes going through some trying times together to develop those kind of relationships. But when we have an opportunity like this to prove to our customers that we can offer them a lot more, then we hope to have our customers' children and their grandchildren bank with us, much like what Rich said. We're cultivating our customers not just for what they do for us today or what we do for them today. We plan to be the bank for our customers' children and grandchildren in the future.
Rich, thoughts from your perspective as a producer and head of Kansas Farm Bureau?
Well, I don't think there's any question. As Leonard alluded to, relationship is paramount. Anything we do, we have to have a great relationship. But from the producer standpoint, I think it's very important, especially when you go into challenging times like this, and even prior to this, with some of the issues that we were having to cause commodity prices to be depressed. You need to be able to go in a very business-like manner and visit with your banker and have a plan, so that both of you know exactly what your intent is going to be. When is the flow of money going to need to be, you have access to it, and also what type of a repayment plan are you going to have? So it's a business relationship from both of you standpoint, and the banker providing that cash flow to make the whole system.
I want to step back and reference a time that we discussed before going on air today, and that was the 1980s. It was a very trying time for agriculture. There was, in my opinion, I was a teenager with a cow note that had about 21% interest tagged on it. Extremely tough times, and mine was nowhere the size of what an actual operator would have been. But I do remember writing those checks and interest in trying to make principal payments. But from my perspective, back then, I believe there was a lot of distrust between producers and their financial institution. Do either of you see that as a different case scenario? From my perspective, I think our producers today and their lender are more of a team approach to making the finances work for the operation. Would you like to address that?
I'll start out with it. Yes, there are some similarities, but I think also is the one fact that you mentioned, Duane, was that 21%. I experienced that in a major way myself, and how we lived through it, I really don't know. But the interest rate, the relationship with the bankers and the lending institution, I think is much more fluid now than it was at that time. There was the idea that we couldn't lend enough money was part of the issue going into that. Bankers and the regulators have been much more responsible now and making sure that the borrower clients are in a lot sounder position.
Well, I agree 100% with that, Rich. I actually started my first job in the bank out of college was in 1979. I went back to my hometown in Cedarville, Kansas, and it was a really trying time. There's a lot of differences today, though. The primary difference is in the interest rates. Instead of 21%, we have a 3.25% prime. But what makes our industry, the financial side of it, so much stronger is that if we are entering into a more prolonged period of economic downturn in the ag sector, I think the farmers are better prepared going in for this. They're not nearly as leveraged as they were going into the 80s. That's first and foremost, especially when leverage means debt. And at that time it was impossible to pay 21%. There's not 21% margin hardly in anything that you do today. So, it would eat up the margins really quickly. In addition to that, the financial industry is at a position of strength. Unlike we're at the strongest position capital-wise. The first line of defense for us is our loan loss reserve. In the 1980s, the average bank had 0.25% in their loan loss reserve. Today, that number is 10 times that amount, almost 10 times that amount. The average bank going into the 1980s had a 6 or 7% equity capital ratio. Today, that number is somewhere between 11 and 13%. So we have 7-8 times as much on the first line of defense and twice as much on the capital side. So, we know that we're going to in very trying times, we're going to dig into that. That's what we're here for. And but our customers they're also entering into this in a position of strength, but so are the banks. So between the two of us, I know we can make this work. I'm absolutely confident that we can.
Leonard Wolfe, United Bank and Trust in Marysville, Kansas, and Rich Phelps, President of Kansas Farm Bureau, joining us on Rural Report. It is a program that enlists experts to provide Kansas farmers and ranchers with the latest information, brought to you as a partnership between Kansas Farm Bureau, KFRM, and WIBW. As we continue our discussion with Leonard Wolfe, United Bank and Trust at Marysville, and Rich Phelps, President of Kansas Farm Bureau. Gentlemen, a question we'll throw out to both of you, and you can arm wrestle to see who goes first. But while ultimately eligible for the Paycheck Protection Program, farmers and ranchers made little use of it for a variety of reasons, one of which may be that the program, as I understand it, is basically out of money at this time unless we get another allotment. With Congress and the administration negotiating more funding for that PPP, what do producers need to do now in order to potentially take advantage of this program in the future?
Yeah, Rich, I'll take the first shot at this one,
Yes.
if you don't mind. Well, the Paycheck Protection Program, the PPP, is just a beast. We've never seen anything like it before. The guidelines for this program actually came out the night before we could start sending applications in. The guidelines have been constantly updated and new interpretations communicated almost daily with us over the past 3 weeks. The first day it was open was Friday, April the 3rd. And in fact, the guidelines for self-employed applicants were changed just the day before the fund ran out of money. So if they do come back with more money, we're expecting that there will be changes. There has been nearly every day since they started. And I'm only saying that because the program, with it changing every day, probably a lot of what we're talking about today might not even apply tomorrow or whenever it looks like it's going to be probably next week before they get more money in there. So now to try to answer your question specifically about the farmer and rancher participation in the program, it's my opinion, our bank's opinion, that the PPP is just not a great fit, either for the self-employed, but specifically for the small to medium-sized farms. The amount that a farm can qualify for is determined by their Schedule F on their tax return. So you take the net farm profit or loss, which is line 34 on Schedule F, you divide that number by 12 times 2.5, the equivalent of 2.5 months of income, net income on the farm. Obviously, line 30, if line 94 is negative, you don't even qualify. You're not eligible for the program. So if a farm takes advantage of depreciation, prepaid expenses, or maybe deferral of income to limit their taxable income, that works against you in qualifying for PPP. The maximum that any farm without employees can qualify for is around $21,000 plus health insurance and other qualified benefits. And the way we arrive at that is that it's limited to $100,000 annual compensation per person. So if you divide that by 12 times 2.5%, that's $20,833. And then, like I said, you could qualify if you had, health benefits or other benefits you could add to that. And obviously, if you have on-farm employees, you could qualify for a little higher amount. But again, it's tied to your Schedule F, and as we all know, most farmers defer as much taxable income as they can. So just if they take advantage of current tax laws, a lot of times they don't qualify. I just suggest that if it does come back with more money, they change it so that it could be the earnings before taxes, interest, and depreciation, EBITDA. That would be the qualifying amount, and that would put farms and other self-employed applicants on par with the other business entity types like LLCs and corporations, where the qualifying amount is not determined by profitability. And those are the big differences that I can see would make it more usable for for all self-employed and specifically small farms and ranches.
Rich, thoughts from your perspective?
Well, I think Leonard covered the basics very well. From the farmer's standpoint, the first thing that he mentioned was about the self-employed and the question whether self-employed was going to be included or whether it wasn't, the complexity, the unknown, and then probably as farmers we don't move on some of these programs maybe as quickly as other, and by that time, as he indicated, the money had dried up. So a lot of question and reservation, I think, from the farmer self-employed standpoint.
Leonard, talk a little about reports of financial institutions struggling to become SBA-approved lenders and other regulatory uncertainties that this PPP program has brought to light. And can you tell us from a Kansas banking focus about those struggles and where financial institutions stand today on their ability to participate in that program?
Sure. Yeah, the SBA really struggled. Number one was providing access to banks. They have a portal that's called the E-Tran, and as it turned out, it made no difference whether or not you're already an SBA approved or certified lender. And I understand that about a third of our Kansas banks still didn't have access through that portal 6 days after the program opened on April the 3rd. So there was a lot of frustration, a lot of angst going on that we weren't going to be able to, that some of our banks weren't going to be able to provide our customers with what they needed. Our bank actually gained access early, and then our lenders started entering our customers' applications on April 4th and 5th. We worked all day Saturday, all day Sunday. That first weekend, we thought this might be like a Garth Brooks concert that might sell out in an hour. So we were anxious to get our people's applications in there and in the queue. Also, the people here at our bank helped other banks gain access and navigate through the process of entering those applications. There are a lot of glitches in the program, some of which have been fixed, but not all of them. But one of the biggest issues that I want to talk about was that the application that the SBA provided for our small businesses to complete didn't even include all the information that would be needed for us to file our side of the application to the SBA. It would have been really difficult to get the information needed from a non-customer. We were able to refer to our customers' files and get everything we needed. And I know that one of the criticisms of the program is that banks would only provide access to their own customers. But again, I'll refer back to earlier question about relationships. We felt a responsibility to our customers to spend all the time that we needed to in order to get them in the program. As a matter of fact, when the fund ran out of money last week, we had gained approval for every application we had completed at our bank. Since then, we've received a few more, but we're waiting to submit those if more funds are made available. Every one of our loans that was approved has been funded. That money is in their account and is available for them at the bank. And in all, I know that the latest report shows that in Kansas, banks provided $4.3 billion in Paycheck Protection Program loans for customers in Kansas. So.
Well, certainly it is a dynamic and changing environment when we think about ag finance and ag lending in the midst of this coronavirus COVID-19 pandemic. Word out late last week that there would be an additional $19 billion earmarked specifically through USDA for agricultural producers and commodity purchase programs. As of yet, we don't know the specifics of that, but anticipate that coming up in the days ahead. We'll thank Leonard Wolfe, United Bank and Trust of Marysville, Kansas, and Rich Phelps, President of Kansas Farm Bureau, joining us on Rural Report. Again, a production of Kansas Farm Bureau in partnership with KFRM's Duane Toews and WIBW's Greg Akagi. Look ahead, the upcoming third edition of the Rural Report will include comments from Oklahoma State University's Dr. Darrell Peel and American Farm Bureau Federation's Scott Bennett discussing recent volatility in the beef cattle market. Have a great day.